The relationship between Iran and China has a long history, dating back to the ancient Silk Road, which facilitated cultural exchanges and economic ties. This relationship deepened significantly during the 1980s, particularly during the Iran-Iraq War from 1980 to 1988. China provided Iran with arms and military equipment, capitalizing on Iran's international isolation and helping to lay the groundwork for the current strategic ties. The relationship reached a new level in 2016 when Chinese President Xi Jinping visited Iran, resulting in the signing of a comprehensive strategic partnership. This partnership was further solidified in 2021 with a 25-year cooperation agreement encompassing economic, political, and military dimensions. The partnership is vital for both nations, as Iran serves as a crucial energy supplier and a key node in its Belt and Road Initiative. China's relationship with Iran highlights a larger strategic issue, as Beijing's leaders tend to sympathize with Iran's stance on global affairs. In 2023, China imported an average of 1.1 million barrels per day of Iranian crude oil, accounting for around 10% of its total crude imports. This marked a significant 70% increase in Iranian oil imports compared to the previous year. Most of this oil is purchased by independent Chinese refiners known as teapots, which have minimal exposure to the United States financial system and face less risk from United States sanctions. China's ability to sustain such high levels of Iranian oil imports stems from creative tactics like ship-to-ship transfers and relabeling oil as coming from third countries such as Malaysia. This circumvention of US sanctions has been crucial for both countries as the world's largest importer of foreign oil. China has invested heavily in energy and infrastructure projects across the region, particularly in countries like Saudi Arabia and the UAE. China perceives a decline in American influence in the Middle East as an opportunity and has cultivated relationships not only with Iran but also with its rivals like Saudi Arabia. China frames its significant investments in the region as part of its Belt and Road Initiative, aiming to increase trade and China's influence. Beijing appears hesitant to invest heavily in comparison, placing more strategic importance on its relationships with Russia and North Korea, both of which share borders with Iran. As the Middle East risks falling into deeper conflict with Iran, China's limited diplomatic leverage could be exposed. China and Russia have long been a source of geopolitical tension, with China supporting Russia's defense sector but refraining from providing weapons for the war in Ukraine. However, China maintains a cautious approach, opposing Russia's threats of using nuclear weapons regarding North Korea. The recent developments in Iranian missile deliveries to Russia further complicate the geopolitical landscape. On September 6, Washington confirmed that Iran had begun delivering several hundred close-range ballistic missiles to Russia for use against Ukraine, marking a new phase of military collaboration between Moscow and Tehran. China's declaration of support for Iran during a meeting between Foreign Minister Wang Yi and Irani President Masoud Pezeshkian on the sidelines of the United Nations General Assembly adds another dimension to this complex situation. Wang Yi told Pezeshkian that China backed Iranian efforts to safeguard the country's sovereignty, security, territorial integrity, and national dignity. A black market deal is underway, and those involved could end up in jail if they are caught. Argentina's economic crisis has reached a critical juncture with the collapse of its dollarization efforts sending shocks through the global financial system. The South American nation's chronic inflation and macroeconomic instability have long been a cause for concern, but recent developments have catapulted these issues to the forefront of international economic discourse. Argentina's current economic situation is dire, with inflation expected to go up to 123% at the end of the year, marking one of the highest rates globally. The country has defaulted on its external debt and is unable to meet its financial obligations to creditors. Argentina provides a stark example of economic instability, with annual inflation reaching a staggering 21%, the currency the PZO is in free fall, and the poverty rate climbed above 50%. The country's frustration with the economic dysfunction led to the rise of a radical presidential hopeful in the 20,203 election, Javier Milei, who proposed a radical plan to dollarize the economy. This plan went beyond just changing the currency, advocating for the complete elimination of Argentina's central bank. The historical context of Argentina's economic struggles for decades has been crucial in understanding the gravity of its current situation. Previous attempts at currency stabilization have yielded mixed results, with Argentina initially implementing a currency peg linking the peso to the US dollar at a 1-to-1 ratio. However, the currency peg ultimately collapsed in 2002 amid a severe economic crisis, leading to a steep devaluation of the peso and economic turmoil. In 2000, Argentina adopted the US dollar as a currency to control inflation and make it more attractive to foreign investors. This move was seen as a potential solution to the persistent economic troubles that have plagued the country for decades. However, the implementation of the US dollar in Argentina has proven far more challenging than anticipated. The peso continues to lose value at an alarming rate, devaluing by 4% every month, resulting in an incredible 230% annual devaluation. This rapid depreciation has led to a phenomenon known as bad money drives out good, where Argentines hoard US dollars as a safe haven against the collapsing peso. The currency crisis has created a confusing and dangerous situation with dual exchange rates. Officially, $1 US is valued at around 974 pesos, but on the black market, the same dollar trades for up to 3 times the official price, a staggering 70% difference. This massive gap between official and street rates is causing chaos for businesses and consumers alike. Companies struggle to set prices, while ordinary Argentinians find it increasingly difficult to manage basic expenses like groceries and rent. One of the most immediate concerns is the loss of monetary sovereignty by adopting the US dollar. Argentina would surrender control over its monetary policy to the US Federal Reserve, which means interest rates and money supply would be determined based on the needs of the US economy. Another major challenge is the potential reduction in export competitiveness. A stronger currency could make Argentine exports more expensive in international markets, potentially harming key industries and exacerbating the country's trade deficit. This could lead to increased unemployment and economic contraction in export-oriented sectors. The lack of necessary foreign currency reserves poses a significant hurdle. Argentina has a $7.5 billion hole in its foreign currency reserves, meaning it owns fewer dollars than it owes to creditors abroad. Christopher Sabatini, senior research fellow for Latin America at Chatham House, told CNN that the central bank doesn't have enough dollars, and it still has a $44 billion debt with the International Monetary Fund. The government would likely find it difficult to raise the dollars through other means, such as the IMF. The economic implications of dollarization extend far beyond Argentina's borders. Global companies operating in Argentina would face significant challenges in currency risk management and would need to reconsider their cost structures. The transition period could lead to potential investment delays and supply chain disruptions as businesses adapt to the new currency regime for investors. In conclusion, the implementation of the US dollar in Argentina presents both benefits and risks. While it could reduce uncertainty and attract skilled expatriates, it also presents challenges such as increased competition in certain sectors and dependence on the US monetary policy. Critics argue that dollarization fails to address the root causes of Argentina's economic issues, such as structural inefficiencies and persistent fiscal deficits. Some economists suggest that a new homegrown currency coupled with robust fiscal reforms might be a more sustainable solution. Diol at the Peterson Institute proposed that Argentina needs to scrap the existing peso and replace with a new domestic currency, citing Brazil's successful introduction of the real in 1994 as an example. Milei's economic plan in response to the dollarization collapse includes several drastic measures, including a significant peso devaluation reduction in government spending, subsidy cuts, and tax increases. The goals of this plan are ambitious, balancing the budget by the end of 2024, stabilizing the economy, and attracting investment. However, the potential short-term impacts are severe, with economists predicting a recession in 2024, further increase in the inflation rate, and higher costs for citizens. The collapse of Argentina's dollarization efforts has serious implications for the United States, as it raises doubts about the dollar's reliability as a global currency, potentially leading to instability in markets beyond Argentina's borders. Other countries are already exploring alternatives to the dollar for trade, such as China and Russia, seeking to reduce their dependence on a currency controlled by the US. Argentina's struggles could embolden these efforts, encouraging more countries to diversify away from the dollar. This shift could have profound implications for US economic leadership and global financial dynamics. One potential path forward involves strengthening economic ties with China, which already imports 76% of Argentina's beef exports. Shifting focus from dollar dependence to alternative trade partnerships could help Argentina diversify its options and potentially reduce its vulnerability to peso instability. Argentina's latest attempt at economic stabilization through dollarization has collapsed spectacularly, leaving not only Argentina but also the United States facing potential economic tremors. Inflation is expected to go up to 123% at the end of the year, marking one of the highest rates globally. Argentina now faces the prospect of a steep recession, and the country's persistent fiscal deficits have plagued successive governments in a country where the local currency is in free fall. The official currency Milei's dollarization plan aimed to eliminate Argentina's central bank and instill fiscal discipline and end the cycle of hyperinflation. The timeline for this ambitious overhaul was set at 9 months to 2 years, which many experts viewed with skepticism due to the complexity of the task. However, dollarization promised other advantages, such as eliminating currency risk, making Argentina more attractive to foreign investors, and addressing one of the root causes of Argentina's persistent economic troubles. However, the reality of implementing dollarization in an economy the size of Argentina's has proven far more challenging than anticipated. Instead of calming economic turbulence, the push for dollarization has intensified the chaos, leading to the peso losing value at an alarming rate, resulting in a phenomenon called Graham's Law. This has led to Argentina hoarding US dollars, viewing them as a safe haven against the collapsing peso. The currency crisis has created a confusing and dangerous situation with dual exchange rates, with the US dollar valued at around 974 pesos and the black market trading for up to 3 times of actual price. This massive gap between official and street rates is causing chaos for businesses, consumers, and businesses alike. Argentina's economic issues extend far beyond its currency, as the country is in a deep recession with GDP shrinking for 3 consecutive quarters. Businesses are closing, investments are drying up, and the economic outlook grows worse. The human cost of this crisis is staggering, with over 55% of Argentina's population now living below the poverty line, the middle class shrinking rapidly, and daily life becoming a struggle for most Argentines. The collapse of Argentina's dollarization experiment has serious implications for the United States, as it raises doubts about the dollar's reliability as a global currency. This could lead to instability in markets far beyond Argentina's borders, potentially triggering a broader crisis of confidence. Other countries, like China and Russia, are exploring alternative currencies for trade, and Argentina's struggles could embolden these efforts, encouraging more countries to diversify away from the dollar. The repercussions of Argentina's crisis could extend to trade relationships, as a weaker dollar could make American exports less competitive and impact American businesses and workers. To capitalize on new partnerships and create a sustainable economic model, effective governance and strategic policy implementation will be critical for Argentina to capitalize on these opportunities. The technical challenges of implementing dollarization in an economy the size of Argentina are formidable, as it involves complex currency conversion and the exchange of all pesos held by individuals and businesses for US dollars. This would effectively disband Argentina's central bank, handing over the power to set interest rates and print more money to the US Federal Reserve. One major hurdle is Argentina's lack of sufficient dollar reserves, which means it owns fewer dollars than it owes to credit abroad. Additionally, Argentina has a $44 billion debt with the International Monetary Fund, which it does not have enough hard currency to pay back. The government would likely find it difficult to raise the dollars through other means, as the IMF has effectively barred Argentina from accessing international markets while it pays back its debts. To support the new currency regime, extensive legal and regulatory changes would be necessary. Argentina's case is unique due to its scale, as it has already attempted dollarization in 2000, 2001, and 1904, but its $650 billion economy dwarfs these examples. The potential impact and risks much greater are highlighted by Ecuador's experience, which offers some insights after dollarizing its inflation rate fell dramatically. However, Ecuador has still faced economic challenges, including 2 debt defaults since adopting the dollar. The relationship between monetary policy and democracy is also raised. As countries became more democratic after World War I, governments found it harder to maintain the economic policies required to uphold rigid monetary regimes like the gold standard. Maintaining such systems often required both fiscal and monetary tightness, which mostly came at the expense of the newly enfranchised working class. If the transition to a dollarized economy is accompanied by economic hardship, dollarization will probably necessitate fiscal tightening, resulting in a recession and a temporary hike in inflation. Public opinion will at some point become less favorable towards dollarization, and the return to the dollar will need to be prohibitively costly economically and hard to implement politically by future democratically elected governments.